Welcome back to my personal finance course. I'm Tom Mihawk, and this is the second segment of the chapter on estate planning. And we're talking about estate planning taxes. Property transfers before death are called gifts and are subject to gift tax. The IRS doesn't allow you to empty your estate to avoid estate tax. Take a look at this. This is what I used, example of this class I taught last night. The skull and crossbones, I know it's a little crude, but that's meant to indicate when you pass. See if I can get this straight here. And over here are gift taxes, and over here estate taxes. Now, the IRS are not stupid. They don't allow you to give away everything you own prior to your death as gifts. I mean, you may not call them all gifts. You may just say, I'm giving them away to my kids, giving them away to my, alma mater. Well, the IRS calls them gifts, and they tax them as gifts. Assets that transfer after your death are taxed by estate taxes. Transfers after death are subject to estate tax. The federal and state estate tax. Now, this is fairly complicated, but the key thing to know is that there are federal and state estate taxes. Every state is different. Every state's estate tax, and some have inheritance tax. Some, like Pennsylvania, for example, where I'm doing this, have inheritance taxes, and I'll explain that in just a moment. Everyone subject to the amount of assets transferred is subject to a federal estate tax, but you're only subject to the estate tax in the state in which you're domiciled. Now, if you pass in Florida, but you're a Connecticut resident, you're subject to Connecticut state estate taxes. If you're a California resident, but you pass in New York, you're subject to California estate taxes. So the federal estate taxes, the top rate is 40%, gets there very quickly. It's the highest rate. It starts at $1 million and up. Now, individuals have an $11.58 million exemption, and that's as of, this is 2020, and that's as of now, and it was only 10 years ago, it was probably 2 million, maybe less. I was practicing as a financial advisor then, I don't remember exactly, but it was something around there. It's gone up. And what that means is that if your estate is worth 11.6 million or less, theoretically you owe no federal estate taxes. A married couple can shelter 23.16. It's just twice the 11.58 million. Okay, and the gift and the estate taxes are unified, meaning that it's a cumulative exemption. So if you have, you're in a married, if you're a married couple, and you start giving assets away, and you have $23.16 million, you start giving away, you can do this over years. You would file with the IRS to show what you've given. They keep a record of it, and then ultimately, when you reach the maximum exemption, 23.16 million, above that begins the tax, and that's the $1,001 referred to here on the slide. Meaning, if you have $24 million in assets and you give away 23.16, theoretically you can shield all but the approximately million, and that's the amount that would be taxed at 40%. It starts at zero, the estate tax, and then goes up to 40% by $1 million. From $1 million and up, it's 40%. That's, again, the amount of estate tax exposure. There's a federal gift exclusion. It's now $15,000. You can give to anyone. Give to kids, give to friends, give to me, give to anybody. And you don't have to record it, don't have to file with the IRS to have it on record. And that is a very inexpensive way to begin to lower an estate. If you find yourself in a position where you have enough assets and more than you need to live on, and you want to begin to plan for future generations, you just have to give your assets away. If you have 5 children, that's $75,000 of assets you could give away per year. You have grandchildren, others you can give away per year. Generation skipping trusts avoid estate tax when transferred directly 2 generations away. It's a great way to provide for grandchildren and take advantage of generation skipping planning. In Pennsylvania, we have an inheritance tax. 4.5% on transfers to direct descendants like children, 12% to siblings, 15% to others. Notice that it's not the estate that pays the tax, but the recipient, the person inheriting, pays the tax. They receive an amount of the transfer less the amount of the tax. Every state is different. Some have true estate taxes. The state pays the tax and then it's transferred. And it's not broken out like this based on who receives or the relationship to the deceased, what the taxes are. Every state's different. Now, not many pay federal estate tax. That's the argument for not having it. So few pay it, among others, but that's one argument. So few pay it, why even have it? But nevertheless, if you do qualify to pay the estate tax, it's onerous. 40% at $1 million, it's onerous. A will is a legal declaration of a person's wishes regarding transfer of their property after their death. It can be prepared by law firms. You can get it, ideas from online templates, from books. I recommend using a lawyer to do it. If your net worth is low, get a referral to a one-person legal office or a 2 or 3 person legal office. Find someone who friends, family, parents have used, but get someone who's an estate tax expert. I mean, if they have one other practice area or so, that's one thing. But having worked in this area for 7 years or so, 7 to 8 years, I would prefer to see everyone watching this video use experts. You don't have to pay a fortune. Now, if you have a very high net worth, if you're Michael Jackson with 500 million or Prince with 200 million, choose a well-respected firm with maybe multiple practice areas. So when you need real estate advice, you can get it, or when you need international advice, you can get it, or when you need compensation advice, you can get it. But use the estate planning department that are experts at estate planning. They know the latest techniques. They're very smart, hopefully. And watch your costs. You know, you don't have to have even they don't have to have the largest, most expensive firms, but use experts. The cost would be several $100s. Maybe a solo practitioner might charge, depends on where you live, $1,000, $700. Even a larger, even a firm of more attorneys might charge only $1,000 for the first time you have worked on there, and it would be several $1,000s. I had an ultra high net worth client use a very large firm, and you know, the fee came in at $50,000 for will planning, and part of that was because they had their accountant involved in meetings, and we had conference calls and in-person meetings, and it was very hard to keep the cost down. The client wasn't real happy. That was an extraordinarily high fee from an expensive law firm that they loved to use for their foundation work, but they didn't like to use them for their trust and estate work. Now, if you die intestate, it means you die without a will. The laws of intestacy vary from state to state. In general, what happens is they're reasonable, meaning that, you know, if you die with a wife and 2 children, wife gets 50% and children get 50%, meaning they each split 25-25. Or if you have 5 children, it would be split half to wife, half to children. Each of the children would get 10% each. But what if you have a special needs child and you really want them to get 25 and you have 25%, you have 4 other children, and they'll be fine with you know, only whatever the balance is. But the special needs child needs more planning. You know, that's the problem. Or if you have a special relationship or something like that. So that's why you don't want to die intestate. You want to make your own plans known, establish them legally so that they're discharged when you pass. The laws of intestacy also take into consideration if you don't have a spouse, if you don't have children. If you don't have a spouse or children, I think it goes to parents. What about siblings? You know, if you have siblings too, maybe it's split between parents and siblings, but I think it just goes to parents. But you see my point. Plan for it yourself. You need a will, when you have property, and its transfer would matter to your survivors. That's the key thing. More about that to come as we get farther into this chapter. There's the first kind of will to know about is a simple will. It's sometimes called an I love you will or an airplane will, meaning a couple gets on a plane, you know, they're young, and maybe they have young children. They get on a plane to go to the Bahamas and realize, oh no, we don't have a will. Honey, I love you. Oh, I love you back. I'll give everything to you. I'll give everything back. That's an I love you will, or an airplane will. They're doing it on the airplane because they hadn't planned in advance. It's very simple, inexpensive, and that can avoid probate. We'll talk about probate in a little bit too. It can keep it discreet. Trust-based wills that use revocable trusts and pour-over provisions are very popular and very effective. Joint wills with a spouse, work together. Typical format, a will would be written with two witnesses that are not beneficiaries. Keep copies at home in a safe place protected from fire and theft. Not just a safe, although a safe could be good, but a protected place from fire and theft. And maybe a copy at your law firm or at the firm that did your will for you. A letter of last instruction is for wishes that are not covered by your will. So the will may cover, these big picture issues up here, but you may want to do something else. My grandmother, for example, had as a letter of last instruction that she wanted assets, funds from her estate used after her funeral to pay for a luncheon party. And it was at her favorite restaurant. And it was a wonderful event. All my cousins and aunts and uncles were there. And so, this is a letter of last instruction. Also included might be something like, I want, the motorcycles to go to my son, or I want the jewelry to go to my daughter, or I want the grandfather clock to go to Aunt, Jane, because it was originally her parents, or something like that. Those are things that could be covered in a letter of last instruction. An executor is someone whose job is to execute the will. It could be a family member, a friend, someone capable whose job is to settle the estate, sell the assets, pay debts, distribute the assets, arrange for tax filing, and account to a court if necessary. This could be, again, a family member. It could be someone that could be a professional person, just like a guardian. Guardian oversees the care of minor children, manages their estate. Now compare that to a trustee who manages assets on behalf of a trust. A guardian's job is to make sure children are educated properly, make sure if both parents pass, they're raised in the way the parents wanted them to be raised. That's the job of a guardian. I had an executive, $1 million earner. I mean, it's one thing to earn $1 million once in a while or once in your career. When you earn $1 million every year, that's a pretty good life. He had children. He managed 800 some people, so someone that I began to do some work with. And he didn't have a will. And I'd say, why don't you have a will? He said, well, I can't decide on a guardian for my kids. I'd say, just do the will. You can change it later. You can always change it, but you're far worse off not having a will and power of attorney and a healthcare directive in addition. Now, if you need to change your will, like this person I was working with, you can do what's called a codicil. Codicil updates your will. It says any wills done before this date are void. They don't count. It's this is the current will dated X, and this will is my current active will. Codicil makes those changes. If you divorce, remarry, have additional children, stepchildren from a new marriage, you want to be able to update your will. If you become very wealthy or become very unwealthy, you have a turn of business events. If you inherit, you should change your will. If you develop charitable interests, you want to do good works for society or culture or want to influence beyond your death, and if you move to a new state, these are all times when you should change your will. Trusts are independent legal entities formed to own assets for beneficiaries. One thing I want to point out with trusts is don't worry about trust. You see trust language used on TV like, they're a trust fund child, and you think of these, reality television where, these sort of pseudo celebrity kids were, who were from wealthy families and were talked about as being supported by trust, doing all kinds of goofy things. Don't think about that. Trusts are very effective tools to use in estate planning. They determine what happens to your assets now while you're living to benefit your survivors according to your wishes when you pass. The trust actually owns the assets contained within or donated to them. Now, there are two important kinds we're going to talk about. revocable, and irrevocable trusts. But nevertheless, the trust is an independent entity, generally speaking. Don't be influenced by this trust fund language. Be agnostic about the language. Use trust when it's indicated. The trustee's job is to manage and distribute the assets in the trust. It's important. You want to think for the trustee about their capability, their age, their financial acumen, whether they're corporate or personal. Some people argue that corporate trustees, they change over as they move through their career. Personal trustees, you may continue to know. The important point is that there's interaction with the beneficiaries, and you want to make sure that they are going to interact well and make good choices for managing the assets of the beneficiaries, who are likely to be children of deceased parents. All right, so this is the end of segment 2 in the estate planning chapter of my financial planning course. Please come back for segment 3.